Global markets have been running with a clear risk on tone driven almost entirely by the landmark US Iran 2 week ceasefire agreement tied to the reopening of the Strait of Hormuz. This diplomatic breakthrough has rapidly removed the geopolitical risk premium that had been weighing on sentiment for weeks, shifting flows decisively away from safe haven assets and into riskier ones. On commodities, the relief was immediate and sharp. Crude oil plunged more than 4% as fears of prolonged supply disruptions evaporated, with Brent shedding the elevated war premium that had pushed it above $110 earlier in the week. Gold has also retreated around 1.5%, reflecting reduced safe haven demand. U.S. equity indices have posted strong gains in response, led by energy and financial names that benefited from the lower oil backdrop alongside broad based risk appetite. In FX, the dollar has come under heavy pressure across the board, with the dollar index dropping below 99 as safe haven bids unwind. The euro has extended gains on eased energy headwinds for the eurozone. The yen has strengthened meaningfully against the backdrop of lower imported inflation risks for Japan, and the Australian dollar has outperformed as a classic beneficiary of improved global risk sentiment and a more stable commodity outlook. This FX repricing sits against ongoing central bank divergence. The ECB and RBA remain data dependent and relatively cautious on inflation, while Fed rate expectations stay anchored by mixed U.S. indicators. Overall, the Middle East de escalation has been the dominant fundamental driver, delivering a textbook relief rally across traditional markets while underscoring how quickly geopolitics can reshape pricing when energy security improves. We'll be watching closely for any early signs of fragility in the truce, but for now, the tone remains constructive. That's all for now.